Hello world, welcome to Farm the Market. Share buybacks or share repurchase is a straightforward concept. It just refers to the action of a company buying its own shares back at market value, usually from the open market. The interesting part is the reasoning behind why a company decides to buy back shares, and the implications for investors and the company itself. Companies cannot just repurchase shares at will. They must work within an approved framework. This framework is a share repurchase program. This program must be approved by the board of directors, and they must document the goal of the repurchase. After all, the cash used to buy back shares could be used to other ends, like acquisitions or capital expenditures. So, they must give the reasons behind the decision of buying back shares to demonstrate in a reasonable fashion that they are looking after the best interests of the shareholders. Or at least that's what the theory tells us. Another important factor to consider is that any new share repurchase program or any modification to an existing one must be public information. The company must disclose this information by a press release, or it must be included in a filing such as a Form 10Q, 10K, or 8K. The disclosure must be made with enough anticipation to give the market time to process the information, and must include the following information: the objective of the repurchase and the plans for those shares, an estimated time frame for the repurchase, and the maximum number of shares and maximum amount of funds to be expended. For example, here we can see extracts from Apple's quarterly reports from March 2020 and June 2021. During this period, they increased their current share repurchase program to up to $315 billion of the company's common stock, of which $234 billion has been utilized already. As these notes state, they are not obligated to buy the shares, but the repurchase program gives them the opportunity to do so if they consider it appropriate. So, is this action good or bad for the company and the investors? Let's look at the good, the bad, and the ugly regarding shares buybacks. The good. Buying back shares reduces the number of existing shares, therefore making each share worth a greater percentage of the company. Each shareholder now has a bigger slice of the pie, so to speak. If the company considers their shares are being undervalued by the market and sees no attractive alternatives to invest on at the moment, the undervaluation can provide a good opportunity to reward investors and allocate capital more efficiently. Also, there are potential tax benefits to shareholders versus paying a traditional dividend. In some cases, it might also be prudent to buy back shares to prevent or deter potential hostile takeovers. The bad. Executives may be tempted to buy back shares to window dress the numbers in the short term, for example, boosting earnings per share. Buying back stock, if it's not undervalued, even worse, make buybacks when the stock is overvalued. This hurts the investors. They would be better off receiving a dividend or having the company invest the capital more efficiently. Buying back shares should be justified by a strong free cash flow. For example, if the company decides to take on more debt to buy back shares, it's usually not a good sign. The ugly. Executives' compensations are usually linked to metrics such as a stock price or an increase in earnings per share. Therefore, they may be motivated to pop these numbers higher via stock buybacks to improve their compensation, even if that's not the best course of action for shareholders. Even worse, buybacks can help increase the stock price significantly, and insiders can take advantage of this opportunity to sell their own shares when they know they are overvalued by the market. So, there's no single answer. As it usually applies in investing, it depends. Although on the surface, the market usually regards buybacks as a good thing, It's important that you do your own due diligence whenever a company you are interested in announces one, so you can determine if it's a good move or if management is missing the mark. If you found this information useful and interesting, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Remember that everything presented here is for educational purposes only. Thanks for your time.